किया है ना सर?
आप बोले ना टॉपिक कोई कंफर्म नहीं हुआ?
नहीं, टाइटल क्या डालूं?
एक्चुअली सर मैंने जो मैसेज बनाया था ना उसमें टाइटल वगैरह सब मैंने कंफर्म कर दिया था। उसमें क्या अपन 5 डेज का प्रोग्राम है वो पूरा, तो 5 डेज में अपन ने क्या क्या लेने हैं उसके मैंने चैप्टर के नाम आपको डाल दिए थे। तो वो फाउंडेशन
ओके, एंड आपने 22 डाला था, आज तो 23 है।
वो स्टार्टिंग डेट थी 22, लेकिन पूरा शेड्यूल जो है वो 22 से 26 है। आप समझे? मतलब स्टार्टिंग अपन कोर्स का करते हैं वो था वो।
ओके।
यस।
हेलो स्टूडेंट्स, गुड मॉर्निंग। कैसे हो सर आप लोग? वेलकम बैक। तो आज मनोज सर हमारे आईपीसीसी ग्रुप, आईपीसीसी एंड सीए फाउंडेशन के लिए चालू कर रहे हैं सेशंस। तो ओवर टू यू मनोज सर।
यस सर, थैंक यू सो मच। जय श्री राम फ्रेंड्स, प्लीज join fast because today we are going to do something special, that is your partnership account for IPCC group 1 and for CF foundation. Both the partnership introduction, from introduction to death of partner, introduction, admission, retirement and death, right? And I hope you received the notes. I think the notes already given na?
Yes sir, given. Yes sir.
And I'm sharing my screen, so also share it, huh, sir?
Okay.
Yes. Screen is share now, sir?
Yes sir.
Okay. So now friends, first of all, tell me about homework. Yes friends, good morning. What is the position of homework? Tell me fast. Whatever homework I had given, I think it is complete, right? So fair monthly, and I hope fair is complete by all. So now let's jump to the today topic, that is partnership. So make the heading partnership account. Okay friends, as I told you yesterday also, that accounting procedure we had already complete, means entire account we had complete. Now only extra depend on these accounting are come here, means all account basic part is complete, that is from journal entry till final account. Now all remaining accounts are depend on these accounts only. Like we start with partnership account. You know, partnership account is addition to the business when 2 or more person come together to do some business. That is called partnership. But they also do the business, so they have to also prepare the final account. They have to also do the basic accounting, journal entry to final account. So partnership account is also same business like doing by proprietorship concern. That's why what they are do, they are following extra part, means whatever extra in the partnership account, they explain that much only. Because whatever the basic part, that is your journal entry, ledger, trial balance, final account. That is same for proprietor, that's same for partnership. So what extra in the partnership? That is how partnership work when there are more than one owner, because all partners are the owner of the business. So how it's distributed profit among all partners. When two or more person come together, then there may be dispute. So how the control over this dispute? So these things are covered under partnership account. When new partner entered in the business, then what should the treatment? The admission of partner arrange. When some partner retiring from the business, that's retirement of partner. If some partner have no more, then it's a death of partner. So these things means these additional thing we need to cover. Basic part is already done with the this final account. And in your syllabus also they had not given anything for basic part. They had given only extra part which you need to learn because of partnership. Right? So let us start with the partnership. First of all, how many students have about idea about partnership account? Because partnership account is applicable as per Partnership Act, which is the year of Act 1932. Very good. So as per Partnership Act 1932, when two or more person come together to do some business, then it can be called partnership. Right? Now, when two or more person come together, so definitely there is possibility of dispute. So they should make the deed. Right? So when they enter in the partnership, they have to make deed where they mention about all their future term and condition. Term and condition is what? Like how the profit will be distributed among partner, how business is doing. So these things is covered. Now, this is something which is given that partnership deed should be there, but it is not mandatory. Means, if suppose you two or more some very close friend want to start your business, you can start because you have believed that you all are very close friend. There is no dispute in you. You have mutual understanding. So what Partnership Act say? You can start the business. You know, once you start the business, whatever profit come, you can distribute as per your mutual understanding. Partnership Act does not have any problem. But if any dispute arise, then Partnership Act will come in the picture. Means what Partnership Act say? You can start the business, no problem. You can distribute profit as per your decision. You can make partnership deed. But if you don't want to make partnership deed, because you know you are very close friend and you will never have any dispute, so you can start business without partnership deed also. Means this deed is not compulsory to prepare. This deed is not compulsory to prepare because Partnership Act say if all you have mutual understanding, if all you don't want to make any particular deed, then we do not have any problem. You can go ahead. But If in future, but if partnership deed is not prepared and in future any dispute arise, then you have to follow Partnership Act 1932. Means what they say, we do not have any problem. You can go ahead with your mutual understanding. You can go ahead with your regular business. We do not have any problem. But in future, maybe because of some reason, all close friends have some dispute. Then they fight that you not do anything in the business. I am doing everything. I had to make the full capital contribution. You don't have any amount of contribution. So you will not eligible for any profit, or you may be eligible for only 10% profit. So these things should not happen. If such thing is happened, because at the time of start of the partnership, you can make the deed, because when two or more person come, definitely there may be some dispute. So you can make the deed that this is our deed, that how much profit you will take, how much profit I will take, how much capital you will contribute, how much capital I will contribute. So these things you can mention in the deed. But you are not ready. Why? Because you say, I don't want to make deed because we are very close friends. We never have any dispute. So in this case, in future, if dispute arise, because dispute can be arise by any way. Like I tell you one story, which is very specific and practical. There are two very close friends. They are doing a lot of business, and they have very good partnership. One day, both partners' son come on the visit this shop or maybe showroom. So demand the one sugar cane. Because that time sugar cane season is going on. So partner has taken one sugar cane and he just pulled it in two parts. And then, sugar cane have the downside is the good, and upper side is not so sweet. So what he did, he just put it into two parts, and the downside, which is very sweet, is on the other partner's son side. So what he did, he just gave good to our son, and upper side to the partner's son. He just gave like this. Means when they should give like this, instead of this, he give like this, because sweet one is in other's partner's son. So what happened? Because of this, other partner has find that now we don't have any relation, because these things should not happen. If my son is in the good side, that means you should give the that sugar cane to my son. So that is little bit dispute, and because of that, their partnership get dissolved, and that dissolution happen after that both partner are no more friends. So there may be any dispute in the future. What we should do? We have to just follow Partnership Act 1932 if there is no deed. So what Partnership Act say, if there is no deed? They say that now we will not follow any rule. You have to just follow the following rule, which is given in the Partnership Act, right? So what is these rule? So now, first of all you know that if partnership deed is not there, then we have to follow the Partnership Act 1932, which say profit will be distributed among partner in the equal ratio. Means partner cannot say I am doing more work, that's why I should get the more profit percentage. They say profit will be distributed among all partners in the equal ratio, because If you want to specify it, then you should mention in the deed. But you had not mentioned in the deed. That means you had not specified. So now you have to follow our rule, because we had given chance to follow your rule, but you had not applied the chance. You had not used this chance. So now you have to follow our system, right? So profit will be distributed among all partners in the equal ratio. First rule. Second, no remuneration to any partner. What they say? If you ask that, suppose some partner is every day use the means goes to the office or maybe go to the shop, so he demand that I should get at least some remuneration like a salary. So what partnership act say? Whatever salary you want, you should mention the deed, but you have not make the deed. That means now for your own work you cannot get any salary, because it's partnership your own. So no remuneration will be given to any partner, whether he do a lot of work, whether he do nothing. Okay. Next, third, if someone say that I had contribute main capital, major capital, so no interest on capital. So no interest on capital, because it's your own fund. You are invested for business. You cannot demand interest on it. So no interest on capital. Next, no interest on drawing, because it's your business, your money. If you use it for your own purpose, that is, you cannot charge interest on it. So there is no interest on capital and no interest on drawing. Only if any partner has given loan to other partner, if any partner has given loan to other partner, then he may be entitled for 6% interest. Means if someone has given loan to partner, then he can entitle for 6% interest. That is the only rule. So if partnership deed is not there, then they have to follow these rules. And you also remember, I'm saying from the beginning that this is the partnership account. So they talk about what is extra in the partnership. They will not talk about how partners profit and loss account calculate, how they make the final account, because that final account we already done. So now we have to focus only on partnership, that how partnership works. So for that they should have deed. But if they not make the deed, then also partnership act say we don't have any problem. But if in future you have any dispute and you don't have any deed, partnership deed, then you have to follow this rule which is given in the Partnership Act 1930. Okay, so can you tell me the ones, all these 5 rules? Please tell me fast. 1, profit will be distributed among all partner equal. Means profit sharing ratio will be equal. Then no remuneration will be given to any partner, because if partnership deed is there where they can mention everything, like how profit will be distributed, how we charge interest on capital, how we charge salary to each other, something they can make. But if they not make, then no remuneration will be given to any partner, no interest on capital, no interest on drawing. And if any partner has given loan to partnership firm, then he can get a 6% interest. Okay, so this is what Partnership Act say, that how we should work for partnership. Right now, this is very big chapter. So chapter cover under this Partnership Act 1932. Means how many types of question, how many types of chapter can possible in Partnership Act 1932, right? First, basically I am talking about from beginning to end. Some part is in CA Foundation, some part in CA IPCC, and some part in CA IPCC as well as CA Foundation Inter. Okay, so all these types of problem can be possible in Partnership Act. I am going to write. First, introduction of partnership. means what is the basic part of partnership, like how partner distribute the profit among partners. For that we make the profit loss appropriation account, how they maintain their capital, because there are more than one owner. No? If there are more than one owner, then they have to keep proper record for each owner, because all partners are the owner, as I told you in the beginning. So what they are saying, that introduction of partnership, where we make all basic detail of partner, these things will cover in the introduction of partnership. Second, admission of partner means when our business is going on, now one new partner we want to enter in the business, then what is the treatment, right? The third, retirement of partner. Retirement of partners means if some partner want to retire, that's said, now I don't want to work more, now I am going to retire, right? Next, death of partner, maybe possible, not retire from business but retire from the life, then it is called death of partner, right? Then fifth, all together, like admission and retirement, or maybe death. One partner goes out, some other partner goes in. So all together. Next, dissolution of partnership. Dissolution of partnership means one partner, now all partners decide that we don't want to business continue, so they dissolve it. It may have two types, a voluntary dissolution and other is compulsory dissolution. Compulsory dissolution means court has ordered that your business is not good, now you have to dissolve it, right? Next, piecemeal distribution. This is one of the dissolution type, right? Next, this is what we are talking about in Partnership Act entire, right? Amalgamation of partnership, right? When two or more partnership firm come together, that is called partnership, amalgamation of partnership. Then sale of partnership firm, we had sell the partnership firm to some other firm or to maybe anyone. And last, conversion of partnership firm to company, means we had convert partnership firm into company. So these overall part, you can see all together: introduction of partnership, admission of partnership, retirement of partnership, death of partnership, all together. So these are first part. Then second part, dissolution of partnership, where voluntary dissolution or compulsory dissolution. Second, piecemeal distribution. Next, amalgamation of partnership. Next, sale of partnership firm. And last, conversion of partnership firm into company. So these things include in the partnership, out of which in your foundation syllabus only first three parts in foundation, and in IPCC group 1 it is in foundation or IPCC group 1, first 5 part. Next 5 part is in CA Inter and IPCC advanced account, not in foundation. Okay, so last 5 part jo hai, that is 6, 7, 8, 9, 10 is not in CA foundation. Only in CA foundation first 5 part is there. Okay, what these first 5 part, can you repeat? One is introduction of partnership, second admission of partnership, third, retirement of partnership, fourth, death of partnership, and fifth, all together like admission, retirement, and death together. Okay, very good. Now, friends, today our target is to finish all these first 5 topics one by one. And for these 5 topics, basic accounting principle they not ask. They ask only how partner extra thing. Wow, what partner should do extra thing for this partnership account? Because basic accounting remains same here as well as in the property final account. So they not ask the basic account because they know that part we had already covered with other topic, right? So let us start with the first part. Introduction of partners. Now, in the introduction of partnership, what part we should include? That how partner distribute the profit among each other. What profit sharing ratio should be there? So for that we use profit sharing ratio. You know, like suppose you are 3 partners, you can distribute equal profit. So one third is your profit. Maybe you distribute, one is 25%, another is 25%, and main partner is 50%. So these are the ratio that how we distribute the profit. But that profit is distributed not only in the ratio but also in the other way. Like we can offer salary to any one partner. But you say, sir, salary is the not a profit sharing. It's a expenses. Yes, it should be expenses. But if salary is given to outsider, then it's expenses. But if salary is given to partner, if salary is given to owner, then it's not expenses. If it is expenses, then everyone claim that expenses and no one will pay the tax. That's why introduction of partnership say whatever given to the partner out of profit or maybe out of the business is all our distribution of profit. And each partner should have capital in detail so that when we find total capital, say any partnership firm have total capital of 100 crore, right? But that 100 crore capital is how contributed by A, how contributed by B, how contributed by C. Suppose there are 3 partners. So how they had contributed. So for that we make the one capital account where we mention each partner separate one column. So these things is covered here. That how partner distribute the profit, how partner manage their capital account so that in the business easily we can find how much capital for A, how much capital for B, and how much capital for C. Okay, understood. So now friends, let's do introduction of partnership. What we do here, we write here we have to just distribute our profit among partner H. There are more than one owner of business, so we will use profit sharing ratio for distribution of profit. Also, if any partner will get any remuneration or commission or interest on capital, that all are covered here under profit and loss appropriation account. For that, what we prepare? Profit and loss appropriation account. So profit and loss appropriation account is prepared to distribute profit among partners, right? Also, how each partner maintain their capital. For that, we have to prepare capital amount, right? So that we can find each partner capital in detail, and that capital can be shown by each partner, that how much capital contributed by A, how much contributed by B, and so on. So there is no dispute in the future. Or we can easily identify how much the capital share by each partner, right? Next line say, in short, we need to prepare two major accounts, two major things under this chapter. This chapter means introduction of partnership chapter, right? First, profit and loss appropriation account, and second, partnership, partners capital account, not partnership, partners capital. Okay, now how to prepare this account? So profit and loss appropriation account is basically start with net profit. Like when you come in the CA inter and final, you will see there is a change in equity statement. What? Change in equity statement. What this change in equity statement say? That whatever the profit you earn, how it will distributed among partners, right? So profit loss appropriation account is showing how profit distributed among partner. In company it is showing how it's distributed among shareholder, maybe how much we had keep with us. But in partnership, we not keep anything with us. Everything will be distributed to partner, because their partner all are independent. All partner have their own capital. So whatever profit they earn, they distribute. Then for next year, again they start the new profit earning. Right? So profit loss appropriation account is just like a P&L which is distributed among partners. So how it's prepared? We make the simple format for this. After getting net profit from P&L account, we'll make this P&L appropriation account, right? So let's start with net profit brought down. You know, when we do the trading account and P&L account, we get the trading account, we get the gross profit in trading account. That gross profit is brought down in the net profit and loss account. So once we get the net profit from P&L account, that profit will be brought down in P&L appropriation in case of partnership firm. So in partnership firm, this net profit which you get from the P&L account will be brought down here. Now, how they distribute it, we just showing here, right? How they distribute, they may be given to remuneration to any partner, say, because A is doing a lot of work, so he gets some remuneration. But it's not expenses, it's a appropriation. It's a profit distribution among partner, because partner is the owner, not an employee. Fit to other thing like interest on capital. Interest on capital may be given to the partner. So all partner will get, say, A, B, C, 3 partner. Whatever the capital we rate, they charge the interest on it and get the interest on capital. Suppose they had drawing also. So why interest on drawing? Why? Because drawing is withdrawn by the partner. So interest will be paid by the partner to the firm. So it's the income for the firm. It will come in the credit side, right? ABC. Now, how to charge interest on drawing? So for that, we'll make the one working note. What working note say? Just I write here. Working note. Calculation of interest on drawing. Now you say, sir, what is special in interest on drawing? Whatever drawing, we calculate the interest rate? No. Drawing is what you know. First of all, you should know the drawing meaning. Drawing is something which we withdraw from the business for our personal use. Now, if we withdraw something from the business for our personal use, that should be withdraw when we require the money. Because we had introduced the money in the business, but we not withdraw immediately. We withdraw after some time whenever we need the money. So, interest should be charged from the date on which we had withdrawn that money. So, they maybe give the date. So, first case, if date is given of drawing, then charge interest from that date. Say we had withdraw amount on 1st of April, then from 1st April we charge the interest till accounting closing year, maybe 31st December, then 31st December. But if suppose date is not given, then how we should charge the interest? So they say if date of drawing is not given, then we assume drawing takes place at mid of the year. So we'll charge interest for half year. Means if date of drawing is not given, then we charge interest for half year. Will not charge interest for full year, because we maybe withdraw at the beginning of the year, maybe withdraw at the end of the year. So we'll charge the average interest, right? Sometimes what's happened, they give the drawing each month because partner need expenses for their own purpose, for their family expense purpose. So they each month they withdraw. So if drawing are fixed in each month, means suppose they had fixed that amount that we will withdraw every month 50,000 for the home or maybe personal expense. So if they withdraw 50,000 per month, it means we can withdraw it at the beginning of the month, we can withdraw it at the mid of the month, or we can withdraw it end of the month. So if suppose if withdraw at beginning of month, that means what? We had taken the money from 1st January onward. So in this case, what they say, you should charge interest for 6.5 months on the entire withdrawal, because its average becomes 6.5. How? That you can calculate. Like I will show. If suppose we withdraw first day of the each month, say 1st January we had withdraw. So on the 1st January withdraw, we charge interest for 12 months, because from 1st January to December, 12 months is there. If we had withdraw next month, then 1st Feb, so we'll charge on 11 months. Next withdraw, 1st March, we'll charge for 10 months. Means whatever withdraw amount, we charge interest on that for 12 months, 11 months, 10 months. And same way, 9 months. And in this way, at the last December 1st, we'll charge for 1 month. Then if you take the average of these months, I repeat, if you take the average of these months, it's come 6.5. How to take average? All 12 month total divided by 12. It's become average. Because each month amount is fixed. So we can calculate interest directly for 6.5 months on entire drawing. Instead of calculating first month drawing 12 months, we calculate on first month drawing multiply by 12 months multiply by interest rate. So it's become big calculation. So we use 6.5 months, right? Second, if drawing at mid of each month, means we had withdraw mid of the month, then we should charge 6 month interest. And if drawing at end of each month, means at the end of each month we are withdrawing, then we should charge 5.5 months. 5.5. Okay, so these are what interest on drawing we should calculate for that much period. I repeat once again, interest on drawing should be calculated from the date of drawing till the accounting end or end of the year. But if that date is given, we can apply interest rate on that date. So first case, if date is given, we apply interest rate from that date. Second case, they had not given the date of drawing, then we should assume that it is withdrawn at the mid of the year, so we charge 6-month interest, half yearly interest. But suppose they had mentioned that every month we are withdrawing fixed amount. Say we had withdraw every month 1,000, every month 50,000. So in this case, we have to again think it is withdraw at the beginning of the month, or at the mid of the month, or at the end of the month. If it is withdraw at the beginning of month, then we charge 6.5%, because 6.5% is become average of period duration, which we can calculate like this way also: January 12 month, February 11 month, because from January to December 12 month, from February to December is only 11 month. So in this way, if we calculate, then that average total of this divided by 12, that average becomes 6.5 month. So we charge 6.5 month interest. If we withdraw at the mid of the month, then it charge 6-month interest, and if we withdraw at the end of the month, then we charge interest 5.5. Okay, so interest on drawing is our income, and which is calculated as per the following rule which we had mentioned. Now, if suppose any partner get the commission, so we write to commission to the partner. Any commission we had given, so that is also written, but to partner only, right? Then after that, whatever balance will be distributed among partner, so profit and loss account transfer to partner capital account in their profit sharing ratio. So in short, we will use PSR. So whatever profit balance will be distributed, balancing figure among partner in their PSR, whatever ratio will distribute. Maybe equal ratio that divided by 3, maybe whatever percentage, maybe whatever ratio they had given, we applied the same ratio. Okay, so this is profit and loss appropriation account. Please see once, so that you understood how the profit is distributed among partner, so that all partner get the detailed profit analysis, they get the proper contribution in the profit, and after that we prepare the partner's capital account, where we mention capital detail for each partner, right? So please see this, and any doubt, any question, please ask. Thank you, sir. Yes, friends, any doubt, any question, please ask fast. So we go ahead with the next part. Chali. So this is the properties of appropriation part. There is no problem at all, I consider. Right? Now next part, that is second part, partners capital account. As all we know, there are more than one partner. Definitely, we need to maintain their accounts in detail. So for that, what we do, we just make partners capital account in columnar form. How? Each column is one column for each partner. So we'll make the partners capital account, particular partner A, B, C, particular partner A, B, C. Now friends, this capital account can be prepared in two ways. One, when we have fixed the partner's capital. So we can divide in two parts. When partner's capital is fixed, means partner's capital is fixed. And second, when partner's capital are not fixed. So if it is fixed, that means capital account contribution will remain same. It will not change because of this regular transaction like a profit, drawing, capital, interest on capital. Because of that, that part is not changed because it's fixed. But if partner's capital account is not fixed, then everything will be included in the capital account. But you say, sir, if partner's capital account is fixed, then where the transaction goes? So for that, we make the separate account that is known as current account. Okay, so we make, if suppose partner's capital account is fixed, then what account we have to make? Partner's capital account, as well as one more account, that is partner's current account. Means we have to prepare two accounts. One is partner's capital account and other is partner's current account. Partner's capital account, what we do? If fixed, capital is fixed, then only we make the two account, right? Now, what we do for fixed capital, we'll make partner's capital account and partner's current account separate. Okay, what include in the partner's capital account? First, balance brought down, which is opening balance by balance brought down. Then, if withdraw of capital, drawing is different and withdraw of capital is different. So if withdraw of capital means we had withdraw the big amount of the capital, right? So if withdraw of capital to withdraw of capital, it's a big amount, then it will come here. If further capital introduced, then it will be coming here. But other than this transaction, the remaining part will be transferred to current account. How? First, balance brought down of current account. It may be credit, it may be debit. Both is possible. To balance brought down. Suppose for A and B, credit balance, and for C, debit balance. Okay. Now, whatever profit is given to the partner will be transferred to current account. because capital account is fixed, right? So that profit and loss, whatever profit we had given in the appropriation, like interest on capital, salary to partner, this thing, remuneration to partner, interest on capital, the debit side figure come in the credit side, because in the journal entry we'll understood and that we had done in the ledger also, right? So by interest on capital, by salary, your remuneration to partner, suppose only for A, fair to drawing, by interest on drawing, right? So like when we had write P&L appropriation account debit sides become credit side, obvious, because ledger posting is there. Appropriation account at debit side, the capital or current account should have credit side, right? After all these things, we'll write the balance by to balance brought down, to balance carried down. Sorry. Whatever balance remain, if debit then debit, if credit then credit. Account is closed. Same way, capital account also closed to balance carry down. Capital account balance should always be credit only, but current account balance may be debit and credit both. And debit credit balance, all these things we had learned in the ledger posting where we did some also, right, in the last lecture. So now this is what capital account record we had maintained for each partner A, B, C. When capital account is fixed, we had make the two account. One is capital account where we include only capital account balance and withdraw of capital or further introduce of capital. And in partner's current account, we include all remaining part, whatever related to the partner. Because in partner's capital account, obvious the item which is related to the partner, that will also include. They will only include. Okay. So now this is capital fixed. Then we make two account. But if capital is not fixed, then what we do? We make only one account known as capital account. And what the include in this capital account? All both account part, means both account together will be included in the capital account when capital account is not fixed, right? So in short, this item is come in the one account only, that is called when partner's capital account is not fixed. Okay, so we'll write note, if partner's capital account is not fixed, then both account will be prepared together. Both account will be prepared together, right? And its name is partners capital. Means the name of this account is partners capital account only. Will not use current account. We make only one account, that is partners capital. Okay. So is it clear, friends, all of you? What we are going to do? We are making the partners capital account. If it is fixed, then we make the two account, that is capital account and current account. Capital account we include only capital withdrawal or introducing of capital. But remaining item will include in the current account. Current account may have debit balance, credit balance, but capital account must have the credit balance only. Subject to each capital means they are in the in the position of the liquidation of the dissolution. Then maybe capital have debit balance. Otherwise, capital should have credit balance. Otherwise, that partner goes to liquidator or maybe partner goes to dissolution. Right? So these things we should consider that capital account should be credit balance and partner's current account may be debit and credit both. And when capital account is not fixed, then entire both account part we include in the one account, that is common account known as partner's capital account. Okay, understood? Perfect. So now friends, this is the introduction of partnership account, where we had start with partnership act, how partnership act work, what is the partnership, when partnership deed is not there, what is the rule we have to follow? What chapter include in the Partnership Act 1932? Overall 10 chapter include. Out of that, 5 chapter in the share foundation, remaining chapter in CA Inter, which will come in the future, right? So out of that 10 part, 5 part in the CF foundation, and first part we had complete, that is introduction of partnership, where we make the penal appropriation account as well as partners capital account. Penal appropriation account showing that how the profit is distributed among the partner, and capital account is showing that how we maintain their capital account balance so that each partner can identify their share in detail. Okay, so I hope all parties clear. Now friends, these things we had written in the small notes, but as I told in the beginning only, we want some special note for that, right? Sorry. So we have to write these notes, but as I told you that I had already these notes. We just read these notes, and which I already shared with you, right? Sir had already shared with you. So we just read once these notes so that you have idea that how, yeah, which type of notes you have to prepare. Okay. So I just open these notes in my screen. I think you can see. Yes. So Partnership Act, when 2 or more persons come together to do some business, then it's case of partnership. Then it's a case of partnership, right? As per Partnership Act 1932, when partners start partnership, they should make the partnership deed, where they will mention all rules and regulation, all, you can say, term and condition between partner, how they distribute the profit, interest on capital, drawing, any remuneration to partner, etc., etc. They should include in that date, right? But partner can start their business partnership without deed also, right? Without deed also they can start the business. But in case of any future dispute, they have to follow rule which is given in the Partnership Act 1932. Means in the future, if there is any dispute and they don't have any partnership deed, then they have to follow the Partnership Act rule which is given in the Partnership Act. These are 5 rules which we had already written, but still we read here, that is profit and loss will be shared equally, right? Profit loss equally share किया जाएगा. No interest on capital, no interest on drawing, no remuneration, no commission to any partner. If any partner has given loan to partnership firm, then it is charged. It can give 6% interest per annum. Right? So, it's 5 rule are there. Now, partnership include, here we had include only the part which is in the foundation, but as per the normal rule, there are 10 part out of this 5 in the foundation and remaining 5 in the CA Inter or IPCC advance account, right? So, what these 5 part: introduction of partnership, admission of partners, retirement of partner, death of partner, and all together, right? Now, introduction of partnership, which we had started. Here, we generally distribute how partner generally maintain their capital account and how the partner distribute the profit. But remember, in final account, all procedure are same. That is trading account, penal account, and balance sheet. Here we have to make treatment after final account. Means here treatment is after final account, because till final account, whether it is cooperative concern or whether it is partnership firm or whether it is anyone, only format and presentation may be different, but final account remain concept same, right? So concept of the final account remains same, which is saying that we have to prepare final account, but in partnership we not prepare the final account, we just start problem with after final account, that is for penal appropriation account and how the partners maintain their capital If partner retire, if partner admit, then what the treatment? All these things we have to cover here, right? So now accounting treatment, as we have already discussed, till final account all treatment are same. So here we need to prepare account after final account, right? These are P&L appropriation account, partners capital account, and balance sheet if specifically asked. Otherwise, balance sheet is not required, because after the changes, if they ask the balance sheet, then we prepare the balance sheet, right? So P&L appropriation account is what? This account is prepared for allocation of profit among partner, either through interest on capital, remuneration to partner, etc., etc. Means how the profit is distributed among partner. For that we prepare P&L appropriation account. The format is there. The net profit, interest on drawing, that is our income credit side. Net profit brought down. This is basically net profit brought down. Net profit brought down. Understood? Then interest on capital, A or B. We are assumed two partner only there. Then salary to partner. Then partner's capital account in. Right? So any salary to partner, then we transfer, and remaining profit will be distributed in PSR, that is profit sharing ratio, right? And then profit will be balancing figure, whatever balancing figure will be distributed to the partner. So that is the balancing figure profit. It will distribute among A and B, and we get the net over. So account will be 10, right? Further, PSR is profit sharing ratio. Then partners capital account. As there are more than one owner, all we know, all partners are the owner. So as there are more than one owner, then it is, that's why it is mandatory to keep their capital record separately and in detail. It can be maintained by two ways. If partners capital account are fixed, right? If capital account is fixed, then we prepare two account. In this case, we have to prepare two capital account, one capital account and another for all other transactions, that is current account, right? So one is the capital account, another is the current account. We have to prepare. Format, partners capital account, where we include only balance brought down and further capital introduced or maybe capital withdrawal, right? So balance carried down will be the balancing figure. Then partners current account, where we include all other transaction. What other transaction? Other than these partners capital account transaction, that is interest on drawing, interest on capital, drawing itself, any remuneration to partner, everything will be covered here. And partners current account balance may be debit or credit, anything, but partners capital account balance must be credit balance only, right? Now note, in capital account we provide only capital withdrawal and capital introduce. And remember friends, capital withdrawal and drawing, there are lots of difference between both. Capital withdrawal means capital withdraw, that means big amount has withdrawn, and drawing means for regular expenditure, for domestic expenditure we had withdraw the money. So drawing is a regular expenditure, but withdrawal capital is a very big amount of withdrawal. So withdrawal of capital will be part of capital withdrawal, means part of capital account, but drawing is part of current account. Okay, current account may have debit and credit balance both, that is also we have written here, right? Now if partners capital account is not fixed, if partner capital account is not fixed, then we have to prepare only one account, that is partners capital account, and all transactions come together in this account. Means if capital account is not fixed, so we take only one account, that is partners capital account, and all transactions come together in the one account only, and that all. Then we partners capital account format we are already prepared. Same way we have prepared when partners capital account is not fixed, then we prepare one account only where all transactions are included together. Okay, so friends, these are the notes which we make for the future revision purpose. As I told you in the beginning only, that for CA not only hard work but also need planning. That planning includes that 80% common part which is used in the each sum, and these notes which we can use in the future for revision purpose, so that any chapter can revise within maximum 5% time of your original time of history, right? So these notes you need to Now we come on the question. So let's open the question book, friends. Come on the ICI website, ici.org. You have the physical material, then definitely use that material only, right? Partnership account, introduction of partnership, treatment of goodwill, admission, retirement, death. So we start with introduction of partnership. So I open that introduction of partnership. You can also use your book, your study material which is received from ICI, right? Let's do the sum so that you have some basic idea how the introduction of partnership account work, how we distribute profit among partner, right? We prepare appropriation account as well as partners capital account. Okay. So let's come to the illustration. We do all illustration basically. So let's do first one, then we do the second. Okay. Illustration 1 in your book. If you are C-Enter student, you can find this sum in your book also, but page number may be different. And question solution system we have to follow as per we have discussed, right? A and B, I am starting with question number 1. A and B start business in 1st January 2016 with capital of 30,000 and 20,000 according to the partnership deed. They had made the partnership deed, right? B is entitled to salary of 500 per month. 500 per month salary, right? And interest is to be allowed on capital 6% per annum. Okay. The remaining profit are to be distributed among the partner in the ratio of 5:3. Means the profit sharing ratio PSR is 5:3, right? During 2016, the firm earned a profit before charging salary to B and interest on capital is 25,000. During the year, withdrawal of 8,000 by A by B and B withdraw 10,000 for domestic purpose. That is the drawing, right? Give journal entry relating to the dividend, division of profit. They'll ask the journal entry. But as I told you that whatever ledger posting we do, from which we can pass journal entry also, because we had not discussed journal entry. Here we had discussed the ledger. We had at the time of ledger discussion, we are discussing how to prepare journal entry from the ledger. Because we have ledger, then we can prepare the journal entry also. So we make the ledger, that is P&L appropriation account and partners capital account. But on that ledger basis, you can pass journal entry also. Directly also you can pass the journal entry, nothing special here. But as we had discussed that we had discussed the ledger only. So we first make the ledger, on that basis we pass journal entry as well. Right? So let's start. Answer to question number 1. And if question is silent, capital is fixed or variable, so we assume capital is variable, means not fixed. Okay. So let's do the question with the page number 8.8, right? So 8.8 from CA Foundation module, right? Profit and loss appropriation account in the same way which we had made in the beginning, because that is the 80% part which is common in the each question, right? Then partners capital account which is not fixed, so everything will include in the one column only, in the one account only. I think there are 2 partners, so we'll make the 2 column, right? Particular partner A, partner B. Particular partner A, partner B. Even first question onward, you can do your own also, Brian. So you can try your own this question also, right? Now A and B are starting partner, 30,000, 20,000 their capital balance. So we write by balance brought down, or maybe you can write suppose they had started, so cash bank 30,000 and 20,000. There is a balance, right? 30,000 A, 30,000 B. According to the partnership deed, B is entitled to salary 500 per month, right? And 1st January they have to start the business and ending on 2016 end. So we can say 2016 December hai, right? So 500 per month B is entitled for salary. So what we write? To salary to partner. To B, right? Not A. 500 into 12. It comes to 6,000, right? And H be posting directly. So if salary come here, so it should be in capital account also by salary to partner in B column 6,000, right? So that entry also done. Understood now? Now next, 6% per annum interest on capital. So capital is 30,000 and 20,000, and it's introduced at the beginning of the year. So we'll charge interest for full year for 6%, right? So interest on capital to interest on capital A and B, 30,000 6%, and on 20,000 6%. 1,800, 1,200. Total is 3,000. That interest on capital also part of current account, capital account, right? So by interest on capital 1,800 and 1,200. Then next part, any profit will be distributed in the 5:3. So we can say to partner capital account, whatever the profit in 5:3 between A and B, right? Then profit for the period up before charging salary and interest on capital is 25,000, right? So what we write? By profit brought down, by net profit brought down 25,000, right? And they say drawing. So to drawing is how much? 8,000 for B, no, 8,000 for A and 10,000 for B. So 8,000 and 10,000, right? So everything we had put in the account, and we can make the ledger also for that, right? We can pass the journal entry also. So now, but the profit just distribute among partner in the profit sharing ratio. So 25,000 is the total profit. Out of that, 9,000 will subtract. It comes to 25 minus 9, 16,000. 16,000 will be distributed in the 5:3, 8, 2, so 9,000 and 6,000 squares 16,000. We can write by net profit appropriation account 10,000 and 6,000, right? So everything is done. Now close the balance, get the balancing carried on, because here capital account is not fixed. So everything is included in the one account only. So 30,000, 800 and 10,000. It's become 41,800. It's 20,000, 6,000, 6,000 and 12,000. 32, 33, 200. Please take the total properly so that calculation mistake should not there. 41,800 minus 8,000, how much? 33,800. 33,200 minus 10,000, it comes to 23,200, right? So with that, we had completed this ledger. Okay. Now let's make the journal entry. As they had asked journal entry as well. So how to prepare journal entry? So journal entry you can make on the basis of ledger also, and you can directly pass journal entry also, right? First they had to start the capital or start the business, right? ABC started business January 2000 with capital 30,000 and 20,000. So you can say entry will be capital come in the picture, cash received by the bank, means cash received by the firm. So cash bank account debit to capital account A and B, 30,000 and 20,000. So this is 50,000 and 50,000. First entry, 4 digits start. Then second entry, remuneration to partner. So what we write? P&L appropriation, account debit to partners C capital, because you see in the appropriation account is written in the debit side, right? And capital account is written in the credit side. In the other way, you can think from the partnership firm, we are going to pay salary. So salary is expense for partnership firm, which is not allowable expense for tax purpose. That's why salary, P&L appropriation, that is salary, debit to partner capital, which is B, right? So B capital account credit. How much? 6,000. So this is the second entry. You can write the narration also. Now third, what they say? Profit 6% interest on capital. So that is also one entry. That is P&L appropriation account debit, because it's debit side. To partner capital account, A capital and B capital, 1,800 and 1,200. Total is 3,000. So this is for capital, interest on capital. Next, whatever profit balance will be distributed among partner. So what the entry for that? So profit and loss appropriation account debit, because it's on debit side. To partner capital account, A and B, 10,000 and 6,000. Total is 16,000. So profit is distributed among partner. Now they have withdraw the capital. So drawing. So drawing means withdraw capital means cash withdraw from the business. So cash should be credit. Whatever goes out should be credit. So to cash bank, debit is partner capital account. A and B. A had withdrawn, B had withdrawn 10,000. So comes to 18,000, right?
मनोज सर,
यस सर, चालू हो गया।
जी बिल्कुल।
सेम स्क्रीन ही रहेगा ना?
स्क्रीन भी शेयर कर दी है, सेम लिंक है, चालू है। ओवर टू यू।
ओके सर। Okay friends, so this is penal appropriation account and your partner's capital account. बैटरी भी पूरी कर दी, right? Now let's do the next sum. We'll try to do all sum. Question number 2 of your CA foundation module, right? Wait, huh? Okay. एक मिनट फ्रेंड्स। Yes, it's visible. Screen sharing visible. Okay. Now, Ram, Rahim, and Karim are partner in the firm. There are three partners, right? They have no agreement in respect of profit sharing ratio, interest on capital, interest on loan, advance by partner, and remuneration payable. to the partner. Means there is no specific agreement. And if no agreement, that means Partnership Act say that if you have not make the deed, if you not make the agreement, then you have to follow Partnership Act Rule 1932, right? In the matter of distribution of profit, they have put forward the following claim. Means they had not made the deed, but they now make the following claim. What they claim? That they make the claim, Ram, who has contributed maximum capital, demands interest on capital at the rate of 10% per annum and share profit in the capital ratio, but Rahim and Karim do not agree. So please friends tell me, if there is no deed, can Ram claim the interest on capital? Answer is no, because interest on capital is not allowed if there is no partnership deed. If there is any deed, then they should mention at the beginning only, no? But they had not mentioned at the beginning. That means now Ram cannot claim any interest on capital. Now Rahim has devoted full time for the running the business and demanding salary of the rate of 500 per month, but Ram and Karim do not agree. Definitely, because now Rahim cannot claim any salary also. Like Ram is not entitled for any interest on capital, in the same way Rahim is also not entitled for any remuneration or any interest on capital, right? Karim demanding interest on loan of which 2000 advanced by him at the market rate of interest, which is 12% per annum. So he can get the interest at the rate of 6% per annum if he had given the loan to partnership firm, but otherwise he cannot claim the interest, right? So Karim can get interest at the rate of 6% if he had given loan to the partnership firm, right? Now, how shall you settle the dispute and prepare profit and loss appropriation account after transferring 10% of the divisible profit to reserve? See, here we have maintained reserve also. So whatever profit come, 10% of that will be transferred to reserve, right? Net profit before taking into account any of the above claim amounting 45,000 at the end of the first year of this business, of their business, right? So now friends, as per the partnership deed, these things are not allowed, as all you know, right? So what we do, these things will not give directly. 45,000 will be distributed among partner, right? For that, what we should write? We should write the rule of Partnership Act 1932, which says that no interest on capital, no interest on drawing, no interest on no remuneration to any partner, and no interest on loan except more than 6%, right? So maximum 6% the interest allowed, but not more than that. So they had mentioned all these rules here. You can see, right? And at the end, we should make the P&L appropriation account, where we just put whatever profit except interest on loan we can give. Otherwise, everything is done, right? So let's do this sum. Answer to question number 2 for the page number 8.9. Profit and loss appropriation account, right? The rule which is you have to write that as per Partnership Act 1932, if partnership deed is not there, then no interest on capital, no remuneration, no profit will be shared equally. All these things you should write, right? So P&L appropriation account, we are making only P&L appropriation. We are making only P&L appropriation account, right? By net profit brought down. How much? Before all these things, this is the solution question here. 45,000, right? So 45,000 to interest on loan, or you can say advances. How much they allow? Karim demanding interest on loan of 2,000 advanced by him at the market rate of interest 12% per annum. So he is not allowed 12% per annum. 32,000 into 6% per annum maximum be allowed, right? So 120 interest is allowed. Then to partner capital account, whatever profit and loss balance will be shared equally among all partner. No need to prepare all these gadgets, right? So 45,000 minus 120 to 44,880 between Ram, Rahim, and one more name, Kareem. In the equal to 44,880 divided by 3, 14,960. 14,960. That's all. Right? So as per partnership deed, there is no partnership deed, so we have to follow company partnership act 1932, which says no interest on capital, no remuneration, no more than 6% interest on loan. So all these things we have to write at the beginning, and then we make this P&L appropriation account. Answer get complete. Next, question number 3. A and B started business on 1st January 2016 with a capital of 30,000 and 20,000. According to partnership deed, B is entitled to salary 500 per month, and interest is to be allowed on opening capital at the rate of 6% per annum. The remaining profit to be distributed among partner in the ratio of 5:3. I think same sum of question number 1, right? During 2016, the firm earned profit before claiming salary to B and interest on capital amounting to 25,000. During the year, A withdraw 8,000 and B withdraw 9,000 domestic purpose. Prepare the profit loss appropriation account. So friends, just we had completed this sum question 1 only, because on that time they had asked general entry, but we had make ledger as well as general entry both, right? So question 3 is done indirectly. Now question 4. Question 4 is prepare the partner's capital account for the same sum, so that we have already done. Means in question 1 we had solved question 1 as well as 3 and as well as 4, right? So question 4 is capital account, which we had already prepared. Now fixed and fluctuating capital, which we are already discussed. Fixed capital have the 2 accounts. We have to prepare 2 accounts. One is capital account and second is current account, right? But if capital is not fixed, then we prepare only 1 account, that is capital account, right? Let's see the next question. If any there question more, 4 question is complete. Yes, interest on drawing concept, I think. Okay. After question, illustration 5 is there, right? Let's do the illustration 5. Interest on drawing, you know now. Interest on drawing, if question is silent, if question is given the date, then charge interest from that date. If date is not given, then we charge interest from the date on which it is actually incurred. If date is not given, then we charge half yearly, and if monthly interest, then we charge according to that. If beginning of the month, then 6.5 month. If middle of the month withdraw, then 6 months, and end of the month, then 5.5 months, right? Illustration 5. A and B are partners sharing profit and loss in the ratio of their effective capital. They had rupees 1 lakh and rupees 60,000 respectively in their capital account as on 1st March 2016. Okay, they had sharing profit ratio in the ratio of their effective capital. So effective capital is only their profit sharing ratio. So we can say profit sharing ratio is 1 lakh raised to 60,000, right? Because their profit sharing ratio and their capital ratio are same. Okay. Further, I introduced a further capital of 10,000 in 1st July 2016 and another 5,000 on 1st July 2016. On 30th September 2016, A withdrew 40,000. Okay. So they had further introduced the capital. They had mentioned capital has introduced this much on that date. Okay, no problem. On 1st July 2016, B introduced further capital of 30,000. First they talked about the A, now they talk about the B. The partner draw the following amount in anticipation of profit. Okay. Draw rupees 1,000 per month at the end of the each month, beginning from January 2016. We draw 1,000 on 30th June and 5,000 on 30th September. Now see, they had covered both things, where A withdraw per month 1,000 at the end of each month, so 5.5 months we can charge the interest, right? And B withdraw in the specific date 1,000 on 30th June and 5,000 on 30th September. So on that we charge interest as per the date, right? Because he had not withdrawn per month same. He withdraw only 2 times, that is on 30th June and 30th September, right? Okay. 12% per annum interest on capital is allowed, and 10% per annum interest on drawing is chargeable. Okay, so interest on capital 12%, interest on drawing is 10%. Due date, date of closing 31st December 2016. Calculate profit sharing ratio, interest on capital, interest on capital and interest on drawing. So what they had asked profit sharing ratio. First profit sharing ratio they want, then interest on capital, then interest on drawing. So what we are going to do, we are going to make one partner's capital account where we put all information, and even we have the information about the profit also. If we have information about profit also, then we can pick the penal appropriation account also. But they had not given information about profit. They just want only 2 items. What these 2 items? That is interest on capital, interest on drawing, and effective profit sharing ratio. The profit sharing ratio is what? Their effective capital. So let's come on the effective capital. Accordingly, we can fix their profit sharing ratio. Okay. So let's charge first interest on drawing and interest on capital, because both things they had do on the different date. So we have to calculate on the basis of date, right? You also start charging your own. I'm also charging here, right? Answer to question number 5. 8.15. Page number, right? We'll write interest on capital first. A and B, 2 partners are there, right? Sharing loss in the ratio of their effective capital. Okay, so we will get the effective capital. They had 1,60,000 respectively in their capital on 1st January 2016. So on 1/1/2016, 1,60,000 are there, right? 1,60,000. Ye introduced further capital 10,000 on 1st April 1/4/2016 को 10,000 he had further introduced. Another 5,000 on 1st July and 30th September, 40,000. 1st July and 30th September. 1st July and 30th September. Right? How much? 5,000 and 40,000. Right? They are the overall capital of that Mr. A. Then 1st July 2016, we introduced further capital of 30,000. 1st July. So on 1st July, 30,000 we also introduced. Right? Here A introduced, here B introduced. So that all. Now what we do, we can calculate interest on individual amount, or we can calculate the effective capital. How to calculate effective capital? You can use this fund we have used for 12 months. This fund also used for 12 months. 1st April 2016 to 31st December 2016, this fund is used for 9 months. Here there is no extra fund. 1/7/2016, this fund is used for 6 months. This is also for 6 months. Next 39, that is this fund is used for next 3 months. Here there is no further fund. So we can calculate the effective capital. How? Either you can use here only 1 lakh into 12 divided by 12. So it comes to 1 lakh only. Or we write here only, okay? 1 lakh into 12 by 12 equal to 1 lakh. 60,000 into 12 by 12 equal to 60,000. Next 10,000 fund they had used for 9 months. So it's divided by 9 by 12. Right? So 10,000 divided by 12 into 9. It comes to 7,500. Next 5,000 used for 6 months. So it comes to 2,500. Here 30,000 used for 6 months. It comes to 15,000. So these are basically effective capital which is actually work for the earning of the fund. Means the capital is introduced or capital is used only for that much period. That is only the effective capital. Right? So next 40,000 used for only 3 months. 3 by 12. This comes to 10,000. It's 0. Now we can take the total 1 lakh plus 7,500 plus 2,500, 10,000 plus 10,000. It's become 1 lakh 20,000. Right? This is become 75,000. Therefore, interest at the rate of what rate they had mentioned on the for interest? Interest rate is 10% on capital and 12% on capital and 10% on drawing. So we charge interest at the rate of 12%. So 1,20,000 into 12%, 14,500, 14,400. And 75,000 into 12% comes to 9,000. So interest on capital and effective capital both are done. Now interest on drawing. How to calculate interest on drawing? So for A we use the one shortcut method, that is per month he using 1,000. So 1,000 into 12. See what they mention about this. A withdraw 1,000 per month at the end of the each month, beginning from 1st January 2016. So 12 month into 5.5 end of the month. That's why we multiply with 5.5 month, right? So 12,000 to 12 into 5.5 divided by 12. Into 10%. Let's give the interest for A. 550. Now interest for B. What they say about B? A withdraw 1,000 per month, right? So for A we had done. Now B had withdraw 1,000 on 30th June. For B, 1,000 on 30th June. So 1,000 into 6 by 12 into 10%. Comes to 50. And further he withdraw 5,000 on 30th September. 5,000 on September, 30th September. So 5,000 into 3 by 12 into 10%. Comes to how much? 5,000 into 3 divided by 12 into 10%. 125. So total interest is 175 for B and 550 for A. This is the total interest on drawings. Okay, so they had asked I think 3 questions. One is proportionate effective capital. Effective capital is 1,20,000 and 75,000, or you can say ratio 1,20,000 raised to 75,000. Right? Interest on capital 14,400 and 9,000, and interest on drawing 550 and 175. You can see the answer also what they had given. Calculate the interest on capital. Capital interest 12,000 for A and 9,000 for B. How much? It's 14,400 and 9,000. 1,75,000, 2,500 and 10,000. 120. On 120, we should, okay, he had withdraw some capital also. I think A had withdraw some capital. Yeah, 40,000 is withdraw. Actually, we had considered 40,000 is the further introduced. So this 40,000 should be less. This 40,000 is withdraw, not introduced. So this 10,000 will be subtract. This comes to 1 lakh. On 1 lakh, 12% 12,000. Right? Because 10,000 he had withdraw. He had considered like a further introduce. He withdraw this. Okay. So interest right 12,000 for A, 9,000 for B. Interest on drawing 550 for A, directly shortcut, and 120, 50 plus 125, 175 for B. Whatever, that is same. Now what is ratio? So 120 raised to 9 lakh, A and B. So we can say ratio will be 120 divided by 9, यानी कि 1.33 raised to 1, right? Here 12 raised to 9. Our ratio is 1 raised to 0.75. 1 lakh or 75,000, right? You can calculate by any way. Answer will be the same. So ratio is 1.7, 1 raised to 0.75. Interest on capital is 12,000 and 9,000, and interest on drawing is 550 and 175. Okay, very good. Next, illustration 6. Ram and Rahim started business with capital of 50,000 and 30,000 on 1st January 2016. Ram entitled to salary of 400 per month, interest and allowed capital and charge on drawing 6% per annum. Profit to be distributed equally after the above notes. Okay, profit sharing ratio is equally. Then during the year, Ram withdraw 8,000 and Rahim withdraw 10,000. The profit for the year before allowing for these items, partnership deed is 30,000. Assuming the capital is fixed, prepare the P&L appropriation account, partner's capital account, and current account relating to the partner. Okay. So basically, it is also similar to question 1 only, but still we prepare, right? Sorry. Let's make the answer to question number 6, right? What the page number? 8.16. Profit and loss appropriation account. We are making because of interest on drawing, right? Because here interest on drawing will be charged for 6 months. Then partners capital account bracket में fixed है and then partner's current account, because if partner's capital account is fixed, we need to prepare partner current account. What the name of Ram and Rahim? So one is Ram, Rahim, Ram, Rahim. Right? Let's make first by net profit brought down. How much net profit we had brought down? Ram Rahim started business with capital 50,000 and 30,000. That is the capital balance. Okay, we write the capital balance as well. By balance brought down 30,000 and 20,000. Then, sorry, 50 and 30 here. 50 and 30. 50,000 and 30,000. Right. Then, salary entered Rahim and it B. Rahim entitled 400 per month salary. Right. So, to salary to Rahim 400 into 12, 4,800. Same salary we can give a non-current account also by salary to Rahim 4,800. Right? Then 6% interest on drawing and 6% interest on capital. So we write interest on capital first by interest on capital at the rate of 6%. 50,000, 6%. On 50,000, 6% is 3,000. On 30,000, 6% is 1,800. Right? Same interest on capital should be charged to penal appropriation also, because this capital, interest on capital, is given to partner as well as it's a part of appropriation. So Ram and Rahim. How much for Ram? It is 3,000 and 1,800. 4,800. 3,000 and 1,800, right? Then by interest on drawing, working note number 1. Interest on drawing. How to calculate? The date of drawing are not given. Then we assume it's, tell me, we assume it's for 6 months. Okay. So mid of the month we had a withdraw, we assume like this. During the year, Ram withdraw 8,000 and Rahim withdraw 10,000. So on Ram, we will charge 8,000 6 by 12 into 6%. And Rahim 10,000 into 6 by 12 into 6%. Right? So 8,000 into divided by 2 into 6%. 240. 10,000 into 6 by 12 into 6%, that is 5,000 into 3. 300, right? Not 3,000. 300. On 5,000 which are 6%. 300. Right? So 240 and 300 should be interest on Ram Rahim. 240 and 300. 540, right? That interest on drawing will come in the current account. 2 interest on drawing 240, 300. By drawing also you should write 8,000 and 10,000. Right? Now let's check the remaining part. Interest on drawing and capital get over. Distribution equally. Whatever profit will come, that will be shared equally. Ram drawing and Rahim withdrawing this much. Profit before all these things is 30,000. Okay, so profit, net profit brought down 30,000. Now profit equally share किया जाएगा, and remaining they say, assuming the capital is fixed, so we had considered fixed capital only. That's why we had made the two ledger, that is capital account and current account, right? So let's calculate the profit, whatever the balancing figure, 30,540, 30,540. So balancing figure will be 4800 into 2 minus 30,540. $20,940. To partner capital account, Ram, Rahim in the equal ratio 1:1. So divided by 2, it's become 10,470. 10,470. So that will be transferred to current account by net profit appropriation account 10,470. 10,470. Okay, that's all. All part are done. So now we have closed already P&L appropriation account. Now we close this account as well. Am I right? So to balance carry down 50,000, 30,000. Now partners capital account, we also close this partners current account. To balance carry down, whatever balance remain, just put that balance 13,470, and this is 726 plus 7 and 17,070, and this is 13,007, 470. 17,007. So it comes to 3, 2, 5, 5,230, and this comes to 7, 3, 10, 6, 6,770, right? So capital account balance is 50,000 and 30,000 because it is fixed, so it remains same. And current account balance is 5,230 and 6,770. That is partner's current account balance. Okay. So now let's check the answer. 10,470 is the balance of profit distributed among all equally. Ram capital, Rahim capital fixed 50,000, 30,000. Ram current account balance is 5,230. Ram average 5,230, and Rahim capital is 6670. 6670. Perfect. So that's all. This is we had prepared current account, capital account, where capital account is not fixed, right? So both account we had prepared as well as we had prepared P&L appropriation. I hope it's clear. Next question. A and B were partners in the firm sharing profit and loss in the ratio 3:2. They admit C416 of share of profit. So now friends, next part is start, that is admission of partners. Okay. So it's a separate chapter, but still they had given the small part. Let's read the first question. C admit 416 share in profits and guaranteed that his share of profit will not be less than 2 lakh, not less than 2 crore 50 lakh. Okay. Total profit of the firm for the year ended 31st March 2017 were 9 crores. Okay. Calculate the share of profit for each partner when guarantee is given by firm, guarantee is given by A, and guarantee is given by A and B equally. देखो, this is the new part which is part of admission, where we have to calculate new profit sharing ratio, right? So before doing this question, let's start with next part, that is admission of partnership firm. Okay, so make the heading admission of partnership firm. Partner, admission of partner. It's a chapter 2. Admission of partners. Right? We had discussed at the beginning only. There are 10 topics. Out of that, 5 we are going to do here because 5 in honors level. So admission of partners we'll discuss first. Then we do that question number 8. Okay. दो मिनट का ब्रेक ले लीजिए, हाँ, जिससे थोड़ा सा एक रिलैक्सेशन हो जाएगा. Then we do.
खा भी थी ना अपनी, पूछ लिया मैंने, क्या बुराई वाली बात क्या है ना? सही किया ना, वो जाइए फिर आकर थोड़ा सारा सामान लेके।
Yes, friends. We'll start. Admission of partner. Now, what do you mean by admission? Nice, simple word. Admission means when any new partner come in the picture, right? So when any new partner entered into the business, it's a case of admission, right? Like we do admission in the college, in the school, right? So here admission means new partner come in the picture. Now tell me, if any new owner come in the picture, then what is the rule? Either we allow him immediately or there is some procedure we should follow. Definitely we should follow the procedure. That what procedure we should follow? That is how they distribute profit in the future. And whatever profit and loss till date, for which only we are responsible. And after that, whatever company earn or whatever firm earn will be shared by new partner as well. I am right or not? So, this is the thing which we have to think at the time of admission. So we need to think following. First, reevaluate assets and liabilities. We have to reevaluate the assets and liabilities. It's our first part. Second, calculate the new PSR, because now in future, how they will distribute the profit. So, calculate new profit sharing ratio, PSR. These two things, and one more very, very important thing, that is adjustment for goodwill. Basically, it is covering the evaluation, but still, goodwill is major factor in case of admission, even in case of retirement, and in case of death. So these three things are used in next three chapters, either in admission or retirement or death or all together in fourth chapter. So these three things we have to think extra compared to introduction of partnership, because it's a regular step. You can say regular process. We had first complete the introduction part. Before it, we had complete the final account part. Before it, we had complete the accounting procedure. So these are step by step. We are going to the next part. So now when admit the new partner, definitely new partner will share the profit. So we have to calculate the new profit sharing ratio. Whatever assets and liabilities value today on that day, he is responsible, he is entitled. Anything previous profit should be veered by or should be distributed by old partner, not by the new partner. Understood? So these things we need to identify here so that we can use that part in detail, right? So for revaluating of assets and liabilities, we make the revaluation account. So one more account will be prepared, revaluation account. What is that revaluation account? We will discuss in the detail. Second, we have to calculate the new PSR, profit sharing ratio. Now this profit sharing ratio are depend on the situation, who will sacrifice, because who sacrifice from which it is deducted and distributed and given to the new partner. So we have to check who is going to sacrifice and what ratio he is going to sacrifice. For that, we have different view or different concept by which we apply the ratio. Then adjustment for goodwill. If we had doing the business from the last 10 year, 15 year, so we have the specific goodwill which we had arrived, which we have generated from the doing our good work. So that goodwill we should not give directly to any partner, any new partner. We should definitely charge for that because we had started with zero. Now we are on this level. When new partner come, then definitely he start with this level. So why we should give our zero to this level to directly to new partner? So for that we charge some extra, that is called goodwill. So whatever goodwill we have generated, we need to calculate and then we distribute that goodwill also. That goodwill part is one of the separate chapter in your book, but we will discuss it with the admission of partners. Okay, so now let's discuss one by one. First we'll discuss new PSR. Okay, then we come on the revaluation. Or let me discuss first revaluation. Okay, so that first part, revaluation of assets and liabilities. Okay, so what do I mean by the revaluation? So whenever a new partner arrives in the company, he will entitle for any future profit that is from today. That's why it's very important to calculate profit. That's why it's very important to calculate profit. And all assets and liabilities to be get at today value by using revaluation account. And whatever profit or loss on revaluation will be shared by all partner in the all old partner, not new partner, all old partner in their profit sharing ratio, in their PSR basically, right? So whatever profit or loss will be distributed among partner in their profit sharing ratio. How to prepare this revaluation account? So revaluation account is just like simple P&L account where any profit that is increase the value of assets or decrease the value of liabilities will be right in credit side. To any loss that is decrease the value of assets or increase the value of liabilities. So whatever net profit or loss to partner capital account, because this is for old partners in old PSR. Understood? So this is the first part, revaluation, where all assets liabilities we get revalued. If profit, then it's come credit side, like increase in the value of assets. If assets value increase, then definitely it's profit. If liability value decrease, then also it is profit. In other way, If any loss, that is value of assets decrease and value of liability increase, then also it is revaluation, but it is loss. So whatever net figure, maybe in debit side, maybe in credit side, will be transferred to partner's capital account in old PSR to old partner, because it's a profit for old, where new partner are not in the picture. But from today, new partner will come, right? And then when new partner arrives, then what's happened? Then whatever profit earned in the future, that is from today to future, will be distributed to all, including new partner, right? Here one new concept is also there to write note. Memorandum revaluation account. What is the concept? Memorandum revaluation account. What is that memorandum revaluation account? They say you make the revaluation, means we want to revalue all assets and liabilities at the current value, so that old new partner not get benefit for that revaluation, and old partner are eligible for that profit or loss of revaluation, right? So this profit and loss we do for old partner purpose, whatever profit and loss on revaluation. But suppose new partner and old both partner want to keep their balance sheet item of assets and liabilities on the same value. I repeat, if old and new all partner want to value or want to keep their assets and liabilities at the same value, like when we bought any home, house, land, 10 year, 15 year, 20 year back, like we had buy the gold long year back. So what's happened? That gold value on that time is very less, but today is very high. But still, we keep in our books the gold value is same, even house value also same. We had bought it before 20 years. On that time, its value is suppose around 5 lakh, but today its value is 5 CR. So if 5 lakh value become 5 CR, but still we are showing in our books 5 lakh only. But when any new partner arrives, will not show it 5 lakh. It's 5 CR value. It's 5 crores value now. So what we do, we increase our assets value from 5 lakh to 5 crores. And whatever profit and loss will be for us, because till that new partner is not in the picture. But if new partner not come, then that amount will remain 5 lakh only in our books, because we don't want to revalue it. Why we should revalue? It's 5 lakh, mention the 5 lakh, no problem. Everyone know that on that time price is property is very less, but now property is very high. So what we can do, that 5 lakh remain 5 lakh in the books only, there is no problem. But when any new partner come, we have to change that value. But after new partner, also partners say that we want to keep that land or house value at 5 lakh only. Now how is possible? New partner will happy because he said that okay, we'll get the 5 CR property in 5 lakh only. But old partner, why we sacrifice for that? Because that 5 lakh value is now 5 CR, but still we want to maintain our assets at 5 lakh only. Then it is possible by using memorandum revaluation account. What is memorandum revaluation account? It says first you revalue like this. Upper side we had valued now. So first you revalue like this. Whatever we had did, we revalued like this. But after revaluation, that revaluation we had did here, after revaluation, you again reverse it. Means first you revalued like this, you're in front of you. After revaluation, whatever profit and loss will be distributed to old partner and old PSR. After that, you make one more account, that is called memorandum revaluation account, and you reverse these part. Whatever you are written debit side, you write credit side. Whatever you are write credit side, you write in debit side. So assets become again on the same original value. You say, sir, if we are going to reverse, then why we had revalue? Because of that profit. What we are going to do, revaluation profit will be distributed to old partner in old PSR. But memorandum revaluation profit is distributed to all partner, including new partner, in new PSR, in new profit sharing ratio. That's why memorandum revaluation account get back all assets in their original value, and because of that, if suppose in revaluation account there is a profit, then definitely memorandum revaluation account there is a loss because it's opposite of revaluation. So that loss will be distributed by all partner including new partner, so that automatically our profit become adjust, or profit is adjusted automatically, and assets become at original value, and profit is also distributed to all partner, so that the future profit will be start from that next profit, and whatever profit we had earned till date is distributed among old partner under revaluation account, and the reversal we had did only for the future purpose. That's why reversal is distributed among all partner including new partner, right? So that is called memorandum revaluation account. I just note here, when partner want to keep its assets and liabilities item at its original value / book value, then they use memorandum revaluation account, where first we revalute assets and liabilities as it is and distributed profit and loss to old partner in old PSR, right? But after that, we will make one more account known as memorandum revaluation account, which is just reversal of revaluation account, and reversal or opposite, you can say opposite, and its and which profit and loss will be distributed among all partner including new partner in new profit sharing ratio. So all item of balance sheet get back at its original value, right? So this is the memorandum revaluation account, which is just opposite of revaluation account, and which is distributed among all partners including new partners, so that when we get back assets at original value, then all partners get proper balance, and we get proper record, and profit will be distributed to all partners including new partners, so that for future value we have reduced again 5 lakh. That means whatever difference profit is beared by new partner also. So first profit distributed by old partner so that they get their profit, then further it is reversed, that is distributed by new partner, because in future new partner also be part of the partnership. Is it clear? So now memorandum revaluation account is just opposite. If they ask specific that you want to keep their assets and liabilities as original value, then only use the memorandum revaluation account. Okay. Now next, profit sharing ratio. In case of admission, some partner will sacrifice, some partner will get, right? So we can say here we have to calculate new PSR. How to calculate new PSR? So old partner sacrificing some share as per any of following method. Means something have to sacrifice by old partner, because first suppose there are two partners A and B, so they are distributing equal. So one, say one roti or one chapati, they distribute half. But once they enter a new partner C, then definitely that one chapati will have to distribute among three parts. So someone have to sacrifice. Now how they sacrifice? Maybe it's possible A sacrifice 100%. Maybe we sacrifice 100%. Maybe you or we sacrifice equally. Maybe you or we sacrifice their profits and ratio. So these parts are possible. So we have to see how they sacrifice. Right? Following method. Number one. If old partner sacrificing in old PSR. First part, suppose old partner sacrifice in old PSR. Right? Next part, if old partner sacrifice equally, right? And if old partner sacrifice in some specific ratio, they maybe give some ratio to us. So if they sacrifice in some specific ratio, then what we have to do? Then we have to specific mention this ratio they are using for sacrifice, right? So now let's we take one example, and where we use all these three types to calculate new PSR, right? So let's take the example. Of new PSR, right? Even we can take the example of our question also, which is we are going to do, like here we selling 3:2, C were admit for 16 share, and granted that share profit will be less than 22 crores. So the profit part we keep aside. We take the example of this only. A and B partners sharing profit and loss 3:2, and they admit C for 16 share. Okay, now what is the new ratio in all our three cases, right? So first we write the question in the simple word. A and B, old partner, profit sharing ratio 3:2. New partner entered for 16 share, say C. Okay, so now 16 share C arise. So what is the new ratio in all these cases? Now let's first case. Then find new ratio. Then find new ratio. Then find new ratio if old partner sacrificing in old PSR. Means old partner sacrificing in old PSR. Then what should be the ratio? Right? So let's do. How much entire share in the business? We know all 1 rupee is the entire share. For any type of business. Means we have the one chapati, right? So if C come for 1/6 share, then how much is the balance? Out of 1/6 minus हो जाएगा, right? So how much remain? 5/6. Now 5/6 will be distributed by A and B in their profit sharing ratio. Therefore, A share, you can say new ratio for A. 5/6. What ratio we will get in the old PSR? That is 3:2. As per this question, 3:2 we have old and new is 1/6. C is admit for 1/6. So 5/6 is the balance share will be distributed among A and B in their capital profit sharing ratio. That is 3/5. 3:2 matlab 3/5, right? So 5 into 3, 15 divided by 30, right? So how much? 15 upon 30, first ratio. Then second ratio, B share. 5/6, he will get 2/5, that is 10/30. Now how much C received? C received 1/6 as mentioned, but we want to mention 30. So we multiply with 5/5. So 5 upon 30, because same figure we multiply with numerator and denominator, there is no problem, right? So therefore final ratio will be 15:10:5 or 3:2:1. So new PSR will be 3:2:1. Are you understood? What we had did, we had considered, first we had assumed the example is, this is the question we had assumed. What question? Let A and B old profit sharing ratio 3:2 admits you C as new partner and 1/6 share. Then find the new ratio if old partner sacrifice in the old PSR. So CS, how much C received? C received 1/6 share. So total share is 1. Out of that 1/6 is reduced. That means 5/6 is a balance. So 5/6 will be distributed by A and B in their profit sharing ratio. It will become the new ratio if old partners sacrifice in old PSR. Means whatever their profit sharing ratio existing, they sacrifice in the same ratio. Right. Now second case, if old partner sacrificing in equally, both are sacrificed equally, right? Therefore, A sacrifice how much? 1/6 share of C into 1/2, that is 1/16, and same by B. B also sacrifice the same. Now, what is the new ratio? So normally new ratio equal to old ratio minus sacrificing ratio. Means whatever old ratio, out of that is sacrifice, whatever is sacrifice, that subtract. We get the new ratio. The formula for new ratio is normally old ratio minus sacrificing ratio. So now what is the old ratio? Old ratio is 3/5 of A for A. How much he sacrificed? 1/16. That means new ratio is, you have to cross multiply 16 into 3, 5 into 1. Right? So 16 into 3 is how much? 48 minus 5 upon 16 into 5. Right? 80. This comes to 43 upon 80. Then B share is 2/5. Minus C also sacrifice 1/16. Again we take 32 minus 5 upon 80. So it's become 27 upon 80. What is C part? C part is 1/6. We want to get 80. So how we can get 80? 80 divided by 6. So if we multiply with 13.33, we can get the 80. Right? So like this, we can calculate. Clear? So what is the new ratio now? So new ratio will be 43 raised to 27 raised to, you can see 43 plus 27, 10. It's not 16 actually, friends. It's 12. 6 into 2, 12 hota hai. That's why it's showing wrong. Because total must be 80. Understood? 13.3 is not equal 80. So it is 1 by 6 into 1 by 2 is equal to 1 upon 12 hota hai. Right? We had mentioned 1 upon 16. So 1 upon 12, 1 upon 12. This is 36 upon 60. This is 24 upon 60. It comes to 31 upon 60. 24 minus 5. 19 upon 60. And 60 we have to get, then 10 multiplied by 10. So 10 upon 60. So your ratio will be 31 raised to 19 raised to 10. It must be equal to 60. You can get 31 plus 19 equal to 50 plus 10 equal to 60. So new ratio will be 31 raised to 19 raised to 10. When old partners sacrifice equally. Okay. So here old partners sacrifice equally. That's why ratio will be 31 raised to 19 raised to 10. Next. Third case. If old partner sacrificing into what ratio? Say 1/3 by A and 2/3 by B of C share. Means sacrificing is specified. A sacrifice 1/3 and B sacrifice 2/3 of C share. So in this case, how to calculate? Again, in the same way, first we calculate the sacrificing, then new ratio equal to old ratio minus sacrificing ratio. Right? So what we write? Sacrificing ratio. A sacrifice 1/3 of 1/6, 1 upon 18. B sacrifice 2/3 of 1/6, 2 upon 18. Therefore, new ratio A equal to, for A how much? Old ratio minus new ratio. Old ratio minus sacrificing ratio. Right? Old ratio is 3 by 5 minus 1 upon 18. 54 minus 5. 18 into 5. 90. Right? So 49 upon 90. Right now? In the same way, B 2 by 5 minus 2 by 18 equal to 90. 36 minus 10. 26 upon 90. C 16. You want to take 90. So 90 divided by 6 multiplied with 15 upon 15. So 15 upon 9. Therefore, new ratio will be 49 raised to 26 raised to 15. It must be 90. Then take the total. 15 plus 26 plus 49 equal to 90. Understood? So these are the new ratio we can calculate in all cases. All cases means, suppose if old partner sacrifice in the old PSR, the first case, if old partner sacrifice in the equally, so second case, if old partner sacrifice in the specific ratio, like 1/3 and 2/3 by A and B, then new ratio will be this. So these are new ratio finding. I hope there is no problem. Here you can get many things like we had write the new ratio equal to old ratio, old PSR minus sacrificing PSR. So you can calculate, if suppose you have old ratio, you have sacrificing ratio, you can calculate the new ratio. If suppose you have new ratio, you have the old ratio, you can calculate the sacrificing ratio. How? Old ratio minus new ratio equal to sacrificing ratio, right? In same way, if suppose you have new ratio and sacrificing ratio, you want to know the old ratio. So you just new ratio plus sacrificing ratio, you get the old ratio. Means from these three formula, we can make any number of formula. At least three we can do. So out of this new ratio formula, we can make old ratio, we can calculate sacrificing ratio, right? So anything we can do, just like we transfer one item to other place, automatically we get the answer. Okay, so I think this is your new ratio. You understood all of your new ratio. Now we come to the goodwill. Then we do the sum. Because goodwill is very big topic and it is separate chapter also in your foundation book, right? So you make the heading goodwill. Now friends, goodwill is one of the very important part for your CA life, because in future you will get this individual topic, valuation, goodwill, and many things based on the goodwill, which you will learn in future CA intern as well as CA final, right? Now first of all, what is goodwill? I think all of you know goodwill is nothing but like a reputation. हमारी reputation क्या है? So whatever your reputation is known as goodwill. But question, how to calculate goodwill? Means what is your reputation? How we know? So answer is on the basis of, we can say, on the public demand, on public view, like Narendra Modi, our honorable Prime Minister. What is his value? So everyone know his goodwill. But if we want to calculate that goodwill in monetary term, then how to calculate? So for that only, we have to think that how to calculate goodwill. Now, first I will give you some example for the goodwill. So you understood what is exactly goodwill, right? What the example I am going to give? Like if you see two shopkeepers, say one medical store, two medical stores are there. One medical store earned say 50,000 a month, and another earned 75,000 a month. So that is because of maybe goodwill or maybe some other part also. But now we're thinking of goodwill. So we just think because of goodwill. Now how it's possible? Both are same so both are doing same business, medical store. Then still one earning 75,000, another earning only 50,000. That is because of their behavior. That is because of their nature. That's why I always say that you keep your behavior very nice. Always respect everyone, because if you respect everyone, you will get the respect in return. So I give the example of both shopkeepers. Suppose you are the guy who used to teach two shops. Now A and B both are different shops for the medical. How their goodwill arise? You just think, right? Suppose you always buy from A. Now I can ask, why you buy only from A? Why you don't buy from B? So you give me some example. Say, sir, one day my headache means I'm not feeling well, so I have headache. So what I did, I just go to the shopkeeper B and ask, sir, there is a headache. Can you give me some tablet? So he responds like, headache, you have to go to the doctor. Ask him. I'm not a doctor. So I just suggested, can you give me one, say, Sarodin or maybe some any tablet which you use for the headache. So he said, okay, you can take. Now I asked for how much this tablets. He says it is 5 rupees. I had given him 100 rupee note. He said, what is this? For 5 rupees I will change your 100 rupees. So he may be deny, or you can ask him that I will pay you later. Please give me the tablet. So he may be denying that why I should pay, why I should believe on you. Then you come to the A and ask, sir, I am feeling not well. My headache is there. So what I should do? He says, sir, you can take the Sarodon. It's good actually. If not feeling, after that also you feeling some problem, you can go to doctor and ask. You say, okay, sir, give me one Sarodon or whatever tablet. He says, lijiye, sir. For how much? Say around 5 rupees. And you give him 100 rupee note. He says, sir, we don't have the change. You keep it, you take this tablet, no problem. You keep pay us later. You say, sir, you don't know me. How can I pay you later? Well, sir, our shop is here only. We know you will return our money. This is the other behavior. So you see how different behavior of A compared to B. So next time if you go, you will go directly on B or A. Definitely you go with A only, because you know B is not a good person. He's not a helping person. Other thing, we can take the example. This is the monetary example. Other thing, we take the example of, say, you are coming from somewhere and you just taken the rickshaw or maybe any public or maybe any transport. When you drop out from that rickshaw, then rickshaw person asks for around 20 rupees and you have 100 rupee note. Rickshaw person says, I don't have the change. You go to the shopkeeper B and ask us, can you give me the change? When he see you for the change, he immediately denies that I don't have the change. You go. So you think that you are not even checked whether you have change or not, because 100 rupees value is 100 rupees only. If he give the change, then it's help you. But value is same. On the other hand, you goes to the A shopkeeper and ask that, sir, I need 100 rupees change. He say, yes, sir, he'll get. He have even only 100 rupees change only, but still he had given to you. Because he know that I will get change again, but you need that. So what is this? This is the behavior. This is the goodwill they are creating. And because of that only, they earn more amount compared to me. So friends, my question is this only. We should create our goodwill. If we create our goodwill, we can earn extra profit by doing the same business. So that goodwill creation is a lot of things, a lot of way by you can create the goodwill. But my question is here to calculate the means calculate how to calculate the goodwill, right? So first of all, we had identified that goodwill means extra earning capacity of the firm. Whoever earn extra, that is because of his goodwill. Okay. So first we write goodwill meaning. It means extra earning capacity of the firm. What do you mean by goodwill? It means extra earning capacity of the firm. That he earned more because compared to B because of his goodwill. Right? Now, how to calculate? So it's based on past profit, because whoever earned more profit, he have the more goodwill. So he is based on past profit, but that profit must be normal. Means if any abnormal profit, like because of some reason A has not opened the shop, means your shop is not open, then you have to go to B only anyhow. So because of some reason, if abnormal happening, then that profit is not count for goodwill purpose, because goodwill is normal, means on normal profit we can calculate the goodwill, right? Also that past profit is analysis, past profit is analysis for the purpose of future expected earnings. Means this past profit we are calculating for the future expected profit. Reason, we are going to enter in the partnership firm. If we are going to enter in the partnership firm, definitely we want extra profit. But when we earn that extra profit in the future or in the past whatever earned is for old partner only. For new partner, they will get in future. So definitely his intention is to analyze past profit for the purpose of future profit. Means he think for future, but on what base? Based on past. Because our past experience give us direction for the future. In the same way, for goodwill calculation purpose, we use past profit, but only for the purpose of future expected profit. Means we want to earn extra in the future. That's why we are using this profit, right? So we had cleared two things. One is goodwill is extra earning capacity of the firm. Means goodwill means, or anything means extra earning capacity of the firm. Whoever earn extra because of his goodwill. Like we had taken the example of medical shop A&P, right? Now how to calculate? So we calculate on the basis of past profit. But why we using past profit? Because of we want to earn in future. So with the intention to earn in future. But that past profit should be normal profit. If anything abnormal, should be immediately removed, because abnormal profit cannot use for goodwill purpose. Now what is the abnormal? Abnormal means any extraordinary which is not the normal course of business, that is called abnormal. Okay, like sometimes suppose because of some reason someone forget their wallet to the shop, and B is not good person, so he had keep it with us. And when person arrive, he say, I don't know your purse, because we are not responsible for anything. So that profit Mr. B has earned, it is not a normal profit. Every time no one will forget their wallet to the shopkeeper. So this type of profit is not calculated for the goodwill purpose, or not used for the goodwill purpose. Is it clear? Very good. Now friends, this goodwill is based on profit, which is past profit but intention to future profit, and we use normal profit. So for that valuation purpose, we can use following 7 steps. I had made 7 steps for valuation of goodwill, because there is a separate topic in the CA final old course valuation of goodwill chapter, where different or maximum possibility question they had asked. So I using same 7 steps here also, but in short way. Okay, so लिखेंगे, we can calculate goodwill by following 7 steps. Step number 1, average profit, but normal. So first we calculate average profit. Means will not take only 1 year profit. Will take around 4-5 year profit, so that we can calculate the average. Normally how much we are going to earn, right? But normal profit. And if that past profit is in continue increasing trend, if it is continue increasing trend, means first 10,000, 15,000, then 20,000, then 21,000, then 30,000, like this, then then we should use weighted average profit. What we should use? Weighted average profit. You know why? Because the profit is going to increase in the future. So we should use the weighted average profit. Okay. So in short, average profit is what? We should take normal average profit. But profit is continually telling that we should take the weighted average profit. Or weighted average profit means we give the weight, higher weight for higher profit. Like 4 year, so we consider last year weight 1, next year weight 2, next year 3, and latest year 4. So latest year we give the 4 weight, and then at the multiply with weight we calculate the weighted average profit, right? So H per following format, can make the format also like year, profit, weight, then product. Multiply with the weight, we get the product. 1, 2, 3, 4. Year, suppose 2001, 2002, 2003, 2004. Profit, say 10,000, 12,000, 15,000, 20,000. We are adding this way. So we get the weight 1, 2, 3, 4. Multiply with this, we get the product 10,000, 24,000, 45,000, 80,000. Take the total of this, take the total of weight. Therefore, weighted average profit equal to total of product upon total weight. We get the weighted average profit. Okay, so step 1 get over. Step 2, FMP. That is called future maintainable profit. What profit? Future maintainable profit. What is this? In future, how we earn the profit. So if anything expected to change in future, suppose today we are thinking that we are going to expand our business. So we are going to appoint a new manager. And we definitely know that if we appoint the new manager, we have to pay the new salary to him. So whatever extra expected expenses which is incurred in the future, we should consider right now. So anything expected change in the future should be considered here. But if it is given in the question, then only we should assume, otherwise we can ignore it. If we ignore, that same step 1 becomes step 2. Right? Now step number 3. Capital employed. Means how much capital we had introduced for earning that profit. So we should use capital. So that is partner's capital. So we take the total of that capital. That is called partner's capital, for which we earn the profit. Now step number 4. Normal profit, that is opportunity cost, which anyone can earn. Means suppose if that capital we not invest in the business, instead of that we make the FD, fixed deposit, then also we can earn something. So whatever we earn from the fixed deposit is known as normal profit. So that much profit anyone can earn. So we should pay good goodwill if we earn more than that. If we are not earning more than that, that means we should not consider goodwill for that. Right? So capital employed, normal profit. How to calculate normal profit? So rate is given. Multiply with capital employed. This is step 3. You get the normal profit. Now step number 5. Super profit. That is what? What is we extra earning? So super profit is what? Extra earning. That is step 2 FMP minus step 4 normal profit. Understood? So this gives us extra profit. Because of this business, we earn that much extra profit. That is we call super profit. Now step number 6. Number of purchasing year. what is this? That is the meaning where we earn extra. Means number of purchasing year, that is how much profit we earn extra each year. But how much that profit continue for the number of years, that is called number of purchasing year. Means that extra profit we earn for how many years. So normally it is given the question, we expected to continue for 3 years, expected to continue for 4 years. But if it's not given, then we can assume 3 years. If not given, then we can assume 3 years. Means whatever extra profit we earn, for how many years, for that we multiply with this number of purchasing year, so that we calculate how much goodwill should be there. Understood? Like example, you all know, like any specific brand you can use, say Haldiram. All you know Haldiram Namkeen, right? So we like Haldiram Namkeen. But suppose Haldiram is bought by you. You had bought it. Now people don't know about that particular thing till what period? Maximum 1 year, 2 years, 3 years, 4 years, 5 years. After that, everyone know that now Haldiram is changed. Maybe you increase the taste of Haldiram, or maybe you decrease the taste of Haldiram. But people aware it after certain period, not immediately, because Haldiram already brand is there, already his sale is there. If you want the Haldiram, definitely Haldiram charge a lot of goodwill from you. So that Haldiram brand will continue for 3-4 years even without knowing that owner is changed. That's why that goodwill is for how many years we have to mention that. Normally it is 3 years we should assume if question is silent, right? Then finally step 7, last step, that is value of goodwill. What is the value of goodwill? So we can calculate by any of following method. What is this method? Number 1, average profit method, where FMP multiply by number of purchasing year. That is step 2 multiply by step 6. Second, super profit method, where we use super profit multiply by number of purchasing year. Third, annuity method, where we not only consider super profit but also time value of money, because all you know that for goodwill we need to pay right now, but in future we will earn, and we know that today money and future money are not same. That is called time value of money, right? So it is also considered under super profit method, under annuity method, where super profit into annuity factor. That annuity factor is given in the question. Okay. Then last, capitalization method. It is nothing but profit capitalization system we follow. What is profit capitalization? So that is profit, or you can say super profit upon capitalization rate. Capitalization rate. They give us capitalization rate. Okay. So capital method say we can calculate the profit, that is super profit upon capitalization rate. Okay. So these are 4 methods which we can use for goodwill valuation. Whatever method they give us, we follow that. If question is silent, then we should follow this super profit method, which is the best. So carbon, because super profit method it gives us correct goodwill, where we pay goodwill not only for whatever we earn, but only for extra earning, because super profit means extra earning. Right? So all these 7 steps, I hope all you understood. Once I repeat also, we are going to calculate goodwill. For that we have to use past profit. Past profit for the purpose of expected to earn in the future, but profit should be normal. So step 1 for valuation of goodwill is finding of average profit of the many years, maybe 4-5 years they give us. But any abnormal profit we should remove from it, profit or loss. We should use only normal profit, right? Now, if profit is continuing increasing trend, then we should take the weighted average profit, that is we had used weighted average, right? Now, step number 2, FMP, future maintainable profit. It means we earn profit in future. What profit we earn in future? Normally, whatever is step 1, that is only step 2. But if anything is specially given that expected future change, like we are going to appoint a new manager, we are going to something different, then whatever expected income or expense increase, that should be considered in FMP. Okay? So if nothing is changed, then step 1 itself becomes step 2. Barabar? So if nothing is mentioned for future, then step 1 itself is step 2. Means step 1 only we use as step 2, right? For capital employed, that is whatever capital we had introduced in the market, in the business. Step 3 done. Step 4, normal profit, that is opportunity cost which we can earn like a FD interest rate, right? So rate is given of normal rate, multiply with capital employed, we get the normal profit. Now super profit, that is extra profit which we earn because of that business, that is step 2 FMP minus step 4, that is normal profit. Then number of purchasing year, that is the goodwill benefit we can get for how many years, that is number of purchasing year. Then last step 7, that is value of goodwill. Average profit method for calculation value of goodwill. Average profit method for that FMP into number of purchasing year, that is step 2 divided multiply by step 6. Super profit, that is super profit in step 4. Step 5, multiply by number of purchasing year in step 6. Annuity method, super profit, that is step 5, multiply with annuity factor given in the question. And capitalization method, where super profit divided by capitalization rate, we get the super profit method. We get the capitalization method of goodwill. Okay. So now goodwill valuation is done. Now what to do? Now we have to use treatment of that goodwill, right? So treatment of goodwill. If we calculate the goodwill for admission purpose, that means new partner have to pay for goodwill to sacrificing partner, right? So we can write, so new partner bracket mein gaining partner, he will gain, gaining partner have to pay for goodwill to sacrificing partner, right? Now he can bring in cash or maybe he can adjust through capital. So right, new partner can bring goodwill in cash or it can adjust through capital, right? If it is bringing in cash, then what entity should pass? If new partner bringing for goodwill in cash, an entity will be cash bank account debit to old partner in old PSR. You say, sir, new partner are bringing goodwill, so we should use goodwill. But to whom he bringing? He bringing for the old partner, for the sacrificing partner. So cash bank account debit, because it's come in the picture, come in the business, to old partner in old PSR, that is in sacrificing ratio, they receive the money. from the new partner, but it's considered their own capital because it is given by new partner because he gaining partner to the sacrificing partner. Okay, आगे बढ़ते हैं. Second, if goodwill is adjusted through capital account. Now, how to do that? If it is adjusted through capital account, it means first goodwill account is raised. How to raise? Goodwill account debit to old partner capital account in old PSR. Means new partner is not bringing cash for goodwill, but we adjust through capital. That is, we reduce the capital of gaining partner and increase the capital of sacrificing partner. How? So first we goodwill raise. First we raise the goodwill. Then we write off the goodwill. How? All partner, including new partner, account debit to goodwill. Because goodwill first be debit, that is raised, then goodwill written off, then goodwill credit. But we credit goodwill and debit all partner, including new partner. So automatically you can see when we raise the goodwill, we use only old partner. So capital account is credit only for old partner. But when we write off goodwill, we use old as well as new partner. So account debit of new partner, which is showing that capital of new partner gets reduced. Right? So this is the two entry which we have to pass when goodwill are adjusted through capital account. Or same thing we can do by other way also. How? By making net entry. We can pass net entry. How? We have to make one working note for that. Working note. Calculation of net goodwill. We are calculating net goodwill, right? How to calculate net goodwill? So say partner A, B and C is the new partner. Okay. We say goodwill raised. That is credit of partner's capital account with A and B only. Because it's the old partner, old PSR. Then goodwill write off. New PSR. That is debit. Will be distributed to ABC, all three. Therefore, net. This is, you can say, less. This is add. So now, or you can say it's a credit, it's a debit. So you can write directly debit or credit balance so that you don't have any confusion, right? So what you do, suppose this is credit balance, you write credit. This is again credit balance, you write credit. This is definitely debit balance because credit is net. Because for new partner, we not give any capital goodwill, but we write off goodwill from his capital account, right? So what entity we can pass? C capital account debit to A capital to B capital. C capital account debit with this amount and A and B capital account credit with this amount. Both must be tally. That is compulsory. Otherwise, account will not correct. Right? So this is the net entry we can pass. Anything data we can use. Okay? This is the treatment for goodwill. I repeat once again. After calculating goodwill, first we had calculated the goodwill by these 7 steps applying. Right? Now treatment of goodwill, that is how goodwill is shown in the books. So for that, new partner may be bringing for goodwill cash, then cash account debit to old partner in old PSR because that goodwill is for old partner because they are the sacrificing partner. So gaining partner will pay for goodwill to the sacrificing partner. Then only the account will be correct. Then only the old partner agree to take the new partner in the partnership form, right? So if bringing in cash, then one entry only, that is fine. But if not bringing in cash, he adjusted through capital. So what we do, we can raise the goodwill by old partner, we can write off the goodwill by the new partner, including old. And net of entry, we can pass by making this simple working note, where we raise goodwill, that is credit, we write off goodwill, that is debit, and net may be debit credit balance, then we pass the net entry. So we can pass the net entry, one entry only, where net goodwill effect is done. And normally this part is used when goodwill account is not shown in the books, because many times the question asks that make the goodwill adjustment by without showing goodwill in the books. So here we not showing the goodwill in the books because nowhere is the goodwill. Only C capital account debit to A capital to B capital. That capital account we use only for the goodwill adjustment. So goodwill account is not shown in the books. So for that purpose also you can use this working note, which is mostly question asked. Is asked in the mostly question. Okay, so I think it's a treatment of goodwill. Now everything is done, revaluation, PSR, goodwill. So now first we do that sum which we had read. Then we jump on the goodwill valuation and admission accounting part. Right? So let's first read this question. A and B were partners sharing profit and loss is 3:2. They admit C for 1/6 share of the profit and guaranteed that the share profitably less than 2 crore 50 lakh. Total profit for the year ended 31st March 2017 was 9 crores. Calculate the share of profit of each partner. So now guaranteed is given by the firm. If guarantee is given by the firm, that means firm first given to the partner C, then whatever balance become will be distributed by 3 between A and B. If guarantee given by A, then whatever profit shortage of A will be paid by A only. And if guarantee given by A and B equally, then they have to calculate whatever the less of share of C that is beared by A and B equally. Okay, so here you can calculate directly profit, no problem. No need to calculate the new ratio like we had discussed here, right? So just calculate the profit. What we write? Answer to question number 8.18. What we write? Profit and loss appropriation account by net profit 9 crores to C profit. Now for C profit, how much we have to given? They say that C is admitted with the condition that 2 crore 50 lakh he will receive anyhow. Now suppose if he use the new ratio, then he should get 1/6. That is, new ratio is equal to 3:2:1. We have already calculated. In first case, you can see here when we start with the new ratio. In this case, new ratio are when old partner sacrifice in the old PSR. If question is mentioned, nothing mentioned, then ratio is 3:2:1. So we can write new ratio 3:2:1. New ratio is 3:2:1. So what we can do? New ratio 3:2:1. H we had calculated the ratio analysis in the ratio part, right? So now, if C share, then how much C will get? 9 crores into 1/6. So we will receive 1.5 CR. But he promised for 2.5 CR. That means 1 CR is less. So now, who will sacrifice? So they say partner capital account, that is A and B. If firm has given the guarantee, That means firm is considered 1 CR less. So our now profit 2.5 less from 9 crore, it become our balance profit is 6.5. So 6.5 will be distributed among A and B because firm has given the guarantee. So guarantee will be bear by A and B in their profit sharing ratio. Okay. So 6.5 will be distributed among partner A and B in the ratio 2. So 6.5 crore divided by 5 into 3, 3.9 and into 2, 2.6. Right? Second case, if guarantee by A. They say na ki if A had given the guarantee. So if A had given the guarantee, then what's happened? 9 crore profit will be distributed among A, B, C in the new PSR 3:2:1. That is 9 divided by 6 into 3, 4.5 CR into 2, 3 and into 1, 1.5 CR. Then if A had given the guarantee, so we subtract from A and add to C. It's become 2.5, it's become 3, it's become 3.5. Clear? Now, third case. If guarantee is given by A and B equally, right? So if given by equally, then what can do? 9 crore distributed among A, B, C in the same ratio 4.5, 3, 1.5. Now 1 CR, that is reduction, will be distributed by both partner 0.5 CR, 0.5 CR. That is 4, 2.5 and 2.5. Okay. So whoever given the guarantee will be sacrificed. So in first case, firm has given the guarantee. That means we had subtract from the firm profit only 6.5 we had distributed among partners. But if A had given the guarantee, then from A share we have to distribute to C. So that is A share 3.5 and B share 3 and C share 2.5. If A and B had given guarantee equally, then both have to bear that 1 crore into 0.5, 0.5. So their profit will be 4, 2.5 and 2.5. So overall 9. In all cases, if you see overall 9. In all cases, it's overall 9. Here also it's overall 9. Right? Because we have to distribute the overall 9 crore. Understood? So it's a new providence and ratio, very small part. Just see. In first case, 3.9, 2.6. Our also 3.6 and 2.9. 3.9 and 2.6. Right? 2.9, 2.6. Then in second case, 3.5, 3, 2.5. Same our also. .5, 3 and 2.5, right? 3.5, 3 and 2.5. And last case, 4, 2.5 and 2.5, right? So same answer you got. Okay. So with that, this chapter get over. Now come to the treatment of goodwill and partnership. Test of knowledge question you have to do your own practice question, right? These are the method of goodwill which we had used. Average profit method, annuity method, super profit method, capitalization method, right? So which already done. Now go ahead with the goodwill questions. We do one sum where we value the goodwill by using all 7 steps. So you get the proper idea how it's work. We are trying to calculate the illustration. We get the illustration 1 in the CA Foundation book, page number 8.33. Okay. Answer to question number 1, 3.33. Sorry, 8.33. Right? Let's read the question. Lee and Lawson are in the equal partnership. They agree to take Hicks as 1/4 partner. Hicks, okay. For this, it was decided that to find out the value of goodwill, Messrs. Letts, Lee and Lown earned profit during 2013 to 2016 as following. You can see 13, 14, 15, 16 profit 120, 125, 130 and 150. You can see profit is an increasing trend, right? 120, 125, 130, 150. So it's an increasing trend. On 31st December 2016, capital employed by Messrs. Lee and Lawson was 5 lakh. Rate of normal profit is 20%. Find out the goodwill following various methods. So here ask goodwill by various methods. Means all 4 methods they want to value the goodwill. So let's do what we should do. First, we should do the step 1, that is average profit. But here profit is increasing trend, so we will take weighted average profit. So okay na? So we use the weighted average profit. How? Here you also do with me. Here profit, weight and product. Years from which 2013 to 2016. 2013, 2014, 2015 and 2016. Right? Profit is 120, 125, 130 and 50. 120, 125, 130 and 150. Weight 1, 2, 3, 4. 1 lakh 20, 2 lakh 50, 3 lakh 90, 6 lakh. Total age 10. This total age 16, 7, 3, 10, 13. 13 lakh 60,000. Therefore, weighted average profit 13 lakh 60,000 upon 10 equal to 1 lakh 36,000. Right? So step 1 get over. Step 2, FMP. We assume it is same because nothing is mentioned for future. Anything change in the future they had not mentioned. Then capital employed. They had given 5 lakh. See in the question. Lee and Lewis capital is 5 lakhs. Right? So they had given 5 lakh. Step 4. Normal profit or you can say opportunity loss 20% given. Therefore amount कितना हो जाएगा? 5 lakh into 20% equal to 1 lakh. Step number 5. Super profit equal to FMP, that is 1,36,000 minus 1 lakh, that is normal profit, equal to 36,000. Step number 6. Number of purchasing year. How much number of purchasing year, friends? Nothing is mentioned about it, so we assume 3 years. Now step number 7, that is final goodwill. by various method. तो सबसे पहले एवरेज प्रॉफिट मेथड. How to calculate by using average profit method? FMP into number of purchasing year. FMP is step 2, number of purchasing is step 6. How much FMP? 1,36,000 into 5. Sorry, into 3. Number of years 3 माने ना अपन ने. So what is the goodwill? 136 into 3. You can also give me the amount, friends, जो भी आता है. 4,08,000. Then second, super profit method. How to use super profit into number of purchasing year. Super profit is 36,000 into number of purchasing year 3. So 36,000 into 3. 1,08,000. Then annuity method. Annuity method, this would give the annuity factor, that is super profit into annuity factor. But annuity factor is not given, so we can calculate it. Normally they given the question, but we can calculate how. We have to calculate accumulated discounted factor, accumulated discounted factor for 3 years at the rate of 20%. Now what is this? So CA inter instrument already know, and for CA foundation instrument it will come in the future. That is nothing but if we want 1 rupee after 1 year, then how much we should invest today? So we should invest today, say 0.8. So if we invest today 0.8, maybe we can get after 1 year 1 rupees. But exactly how much? So for that, 1 divided by 1 plus R, that is rate. Get the exactly amount. So 1 upon 1.2. So how much you will get? 1 divided by 1.2. So you should invest today 0.8333. If you invest that much today, you will get 1 after 1 year. If interest rate is 20%. Okay, very good. So now, how to calculate it? So 1 upon 1 plus rate, you have to do 3 times because 3 accumulated here, no? So 1, 2, 3, and then you can take the total of all these 3. It comes to 2.1065. Okay, so annuity factor is 2.1065 into 36,000. You get the goodwill 75,833. Okay, last capitalization method. Super profit upon capitalization rate. Super profit is how much? 36,000. Capitalization rate is 20%. So 36,000 divided by 20% comes to 1,80,000. So we had calculated all 4 types of method goodwill. Is it clear? So friends, they can ask any of these 4 methods we had used here. I think it's a step, just the implementation of a step, nothing extra we have to do, right? It is nothing special. Is it clear? Very good. Now, next question. We can check their goodwill. Average profit method is 4,08,000. Our also its super profit method is 1,08,000. annuity method, it's 75,834 because we had used the annuity factor. They had also used, right? Now in this case, goodwill is 1,80,000. So all four methods we had calculated. Last is 180 only, right? 180. Okay. Now what they say? The following particulars are available in respect of the business carrying on the Ratho. Okay. Capital invested, trading result 13, 14, 15, 16. In 2015 there is a loss. Okay. Market rate of interest on investment 10%. Rate of risk return on capital investment in business 2%. That means normal rate of return is 12% because FD rate is 10%, but we are taking risk also, so risk reward also, that is 2%. So overall FD rate is 12%. Remuneration from alternative employment of the proprietor 6,000 if not engaged in business per annum. So this is again the normal profit, you can say, because if we doing business, that means we are also devoting our time. So normal profit is not only interest on capital but also our opportunity cost. So they say 6,000 is our opportunity cost and 12% is the interest rate. So both total will become the normal profit of our step number 4. Clear? Let's do what they had asked. You are required to compute the value of the goodwill on the basis of 3/8 and on the basis of 5 years. Sorry, on the basis of on the basis of 5 year purchasing of the super profit, means purchasing of super profit. So 5 year we have to consider number of purchasing year and super profit method we want to use of the business. Calculate the average profit for the last 4 years. Means they say you should not take super profit, or you should not take better average profit. You should take average profit only, and definitely will take average profit only because profit is not in continuing increasing trend. In 2013 it's 40,000. In 2014 it's 36,000. In 2015 it's a loss. In 2016 it's a profit of 50,000. So it's not in continuing increasing trend. If profit is in continuing increasing trend, then only we can take the better average profit, right? So we take the simple average only. Okay. So do again in the same 5 steps. So answer to question number 2, page 8.35. First we calculate step 1, average profit. We'll take direct average only, nothing better average. 40 plus 36 minus 6 plus 50. Barabar? 40,000 plus 36,000 minus 6,000 plus 50,000 divided by 4. How much? 46 plus 30, 40, 30, 60, 75, 120. 120 divided by 4. 30,000 is the average profit. Step number 2, FMP, nothing is mentioned, so we consider 30 only. Step 3, capital employed. How much is the capital employed? Capital invested 1,50,000. Then step number 4, normal profit. What is that normal profit? This is 12% on 1,50,000 plus 6,000, right? So 12% on 1,50,000, 150 into 12%, 18,000 plus 6,000 is the salary loss. So 24,000 is the normal profit. Then step number 5, super profit equal to average profit, that is FNP minus 24,000 equal to 6,000 is the super profit. Step number 6, number of purchasing year. They had given this time 5 year. Step 7, that is goodwill equal to super profit into number of purchasing here. Super profit from step 5, number of purchasing here from step 6. 6,000 into 5. So goodwill equal to 30,000. Right? That's all. So goodwill equal to 30,000. See the answer? Yes, goodwill equal to 30,000. Is it clear? Now, sometimes they ask the hidden goodwill. Hidden goodwill is something like we can calculate goodwill by using balancing figure method. So it is called hidden goodwill. But anyway, we'll do the sum. You understood automatically. And same sum given in the CA Enter also, friends. So you can use CA Enter book. Same question are there in CA Enter as well. Okay. Let's do the next question. Question number 3, 8.40. Right? पहले ब्रेक ले ले. हाँ? लंच ब्रेक लेते हैं, लेकिन जब तक आप इस क्वेश्चन को ट्राई करो जिससे आपको समझेगा. क्वेश्चन 3 जैसा हमने किया था वैसे ही है. क्वेश्चन 3 जो कि कैलकुलेशन थोड़ी ज़्यादा दी है उसने. राइट? इसमें ट्रीटमेंट भी आएगा गुडविल का. व्हाट द ट्रीटमेंट ऑफ द गुडविल विच इज ऑलरेडी डिस्कस. सो you try your own. Okay, then after break we'll see. Right? Now we will see again at 3 o'clock. Okay, so till that you can do the break and try to do question number 3. Okay friends, thank you so much. Any doubt, any question you can ask me first. हाँ जी सर, 1 घंटे का ब्रेक देना है. 3 o'clock वापस. तो आप कर दीजिए. मैं लीव नहीं कर रहा हूँ, आप अपने हिसाब से कर दीजिए. आपको जैसा लगे. ये अभी चालू रखना पड़ेगा ना, अगर 3 बजे तक लेना है तो. ठीक है, बंद कर दीजिए इसको. बराबर. ठीक है सर. ठीक. ओके सर.
Yes, sir. We will take break of 1 hour.
Yes sir.
1 घंटे का ब्रेक. सर एक क्वेश्चन सॉल्व किए हैं अपने, क्वेरी सॉल्व कर दिए स्क्रीन पे जो है. तो
What sir?
स्क्रीन पे जो क्वेरी है.
The profit after appropriation will go in the current account or capital account if capital is fixed. In current account beta. Sir, it's audible?
Okay, bye bye.
Okay.
We will start the new link. New link will be provided in the Telegram group.
Okay sir.